Hey guys, it's Josh Brown. I am here with a face that's probably familiar to you if you watch financial television. His name is Peter Boockvar. Peter is a friend of mine. He is the editor of the book report, and he is also the CIO at Bleakley Advisory. I asked Peter to come on and talk about gold. He's had a lot to say about inflation, the potential for stagflation coming up later this year into next year, and gold seems to be the commodity that is most physically expressive of that viewpoint right now. We're going to ask Peter about why gold is taking out $2,000 an ounce, what's behind the rally, and where he thinks it goes from here. Stick around. All right, first of all, Peter, I can't believe I haven't had you on the Compound channel yet. This is your first time with us, right?
I'm excited. I appreciate the invite, Josh.
So I've been dying to ask you about this because I read your notes every day. You do a really good job keeping people informed of what's happening with macroeconomic data, and you have opinions, which is refreshing. It's not just here's the data, it's here's what I think it means. You're looking at the potential for stagflation. I think that's really the headline of what you're saying. And it's been a long time since we've really experienced that, most notably in the 1970s. What makes you think that that's a very serious possibility going forward?
Well, I would consider my thought like stagflationary light. I mean, the 70s was unusual when you had double-digit inflation, double-digit interest rates. So my definition of it today is more of just mediocre economic growth with sticky type inflation.
Okay.
That so it's right now what we're beginning to see. We're sort of getting a dress rehearsal. Like let's just take a trip to the supermarket. If obviously a lot of it related to COVID, but you had difficulty of food producers, whether it was meat or even General Mills, that had difficulty producing enough of it, of the food, getting it on a truck in a quick time that can then deliver it to a supermarket. So we saw price spikes in different products at the supermarket, which tells me that we're early on and seeing some major supply disruptions from COVID. Now, saw supply disruptions prior with the trade war with China, that you raise tariffs and you start shifting around supply chains. Now, over time, that's probably a good thing because companies get to diversify. But in the short term, you can't just snap a finger and move a factory from one country to another. It takes a lot of time. Not just that, it takes a lot of time to produce the product, get it shipped over, and so on. I'm optimistic that we're going to have a workable vaccine by early next year. So take the airline industry, for example, that have furloughed and have laid off thousands of pilots, tens of thousands of flight attendants. They're not just going to bring everyone back. So while demand, it could come back quicker, supply side is going to take time as planes come back, pilots are going to come back, airlines get to see what kind of staffing they want to have. So you could see a jump in airline prices. You try getting a truck right now to
Well, wait,
deliver something.
well, hold on. Let me push back a little bit. So I agree with everything that you've said, but I think a lot of the grocery related stuff was just hoarding. And year over year, that's not going to be the same situation. Like when you look at demand for canned goods in April 2021, it's got to be down 25% or more. So I think that supply disruption that you're describing, while it's very real, is easily alleviated by one thing that you mentioned, which is people bringing their employees back. But second, less demand. I don't think we're going to be hoarding food next year.
Right. So the demand side still in a slow economy is not going to be robust. All you need is an imbalance between whatever that demand is with the supply side. Take cans, for example. I actually own Crown Holdings, which makes cans
Aluminum
for
cans.
beverages,
Right.
yeah, and food. They cannot make enough cans right now because of the stay at home. So they're adding capacity to existing facilities. They're bringing up, creating new facilities. So there is a rush to meet that sort of demand.
Right.
Uh, so
I
it's
just think it's
I
very I think it's very temporary.
well, inflation typically is temporary. Over
Right.
time, prices go down. You just have to look at technology, for example. The more efficient we are, the more technologically advanced we are, prices naturally go down because we just become more productive, more efficient. When you look back at history, inflationary cycles are more cyclical periods. Now, whether
Yeah.
they last 3 months, 6 months, 2 years, it depends. Eventually, we get back in control. Eventually, supply catches up with demand, and we normalize. So the scenario I'm really talking about is really just a cyclical situation. Now,
Okay.
also, you look at all the central bank liquidity. Now, in 08, 09, when the Fed created all this money, it was more tinder for inflation. It didn't create consumer price inflation because a lot of those reserves that were created by the Fed were left at the Fed. So if you're a bank, I'm the Fed, I buy your bonds. Instead of you taking the cash and lending it out, you just gave it back to me. So it was sort of trapped. If you get a demand side type recovery where the government is obviously giving people cash, so that creates a more of a static level of demand that we wouldn't have had if that person didn't get that transfer payment. You have the potential for banks that are getting squeezed on the net margin side may say, you know what, I need to offset that by increasing loans. So that cash is not left at the Fed. So there's tinder
So
for
that would produce
inflation.
that scenario would produce inflation.
Potentially, and that extra liquidity would potentially create inflation where it didn't create 10 years ago. And
Okay.
keeping the demand side pretty strong in the US. I mean, between the transfer payments by the government has completely offset the declines in wages and income.
By
So
design.
consumers, yeah, by design, you're going to start with a higher base of demand. And then if you get a vaccine, that demand could temporarily overwhelm parts of the supply side
But
of the economy.
wouldn't the transfer payments fade away more quickly in a scenario where there's a vaccine and natural demand comes back? Doesn't that take care of the potential inflation problem that the
Well,
government then pulls back?
it could, but if you get a quick snapback in the economy, you could sustain a level of demand rather
Okay.
than. So if the government artificially lifted demand, and then you sort of get a handoff rather than seeing a dip and then maybe an increase, maybe you continue just to see that increase.
All right, so that will spook the market, and there will be a ton of money trapped in bonds, and I want to talk about that next, that are earning a negative real rate of return. So real rates of return, basically, let's say a treasury is yielding 4%, LOL, not anytime soon,
Yeah.
but inflation is 2%. The real rate there that you're receiving is 2%. It's your yield after inflation. Right now, we're in a situation where there's a lot of money basically being loaned to countries in the sovereign bond market that's earning negative real rates of return, factoring in inflation. And that's obviously not sustainable forever, although the European version of that has been going on for a really long time now. In an inflationary situation, is that who you think is hurt the most? The bondholders sitting in 50 basis point yielding paper?
Yeah, that'll be the immediate impact. I mean, I said in my note today, just imagine the situation where, let's just say the vaccines have success and people start to see. Now, the vaccines will first have success in the latter part of this year. It won't be mass inoculation until next year. But you can imagine
It'll be good enough.
how it'd be good enough for fixed income investors to
I
say,
agree.
wow, the situation I'm in right now is now all of a sudden temporary. And now I have
Yeah.
to switch my attention to a world that will open up again. And
Right.
should the 10-year yield be 55 basis points? Should the German 10-year be minus 60 basis points? Because central banks are doing what they're doing because they want to buy time for the economy until we get that vaccine. So
Right.
imagine if we all of a sudden get that vaccine.
So I'm super bullish on a vaccine. I think it'll come before the election. FDA approval. And I know that they're making millions of batches of several versions of the vaccine. So I don't know who wins and how much will be available. I think it'll be enough. I think people will come out from hiding. Not that everyone's going to take it, but if they can get it to, the big medical systems in Houston and in Michigan and in New York and in California, I kind of feel like that could bring about the scenario that you talk about, just the presence of a vaccine entering the system. I want to pivot to gold. Gold is up 30% this year. It's actually up more than the NASDAQ. So all of those high-flying growth stocks everyone carries on about, they're up big too, but gold is up even more. The gold rally really quietly started in 2018, right? After bottoming in 2015, I think.
Yeah, December 2015.
Okay, so now it's on fire and huge demand coming into gold ETFs. And I think we saw $2,000 an ounce, which on a nominal basis is a new record high. And it seems to be hanging up there. I want to read something that you wrote a week and a half ago that I thought was really interesting, where you compared what's going on now versus the last time gold traded at these levels, which is back in September 2011. So this is Peter, and I want you to react to this. With respect to gold, now that it has reached a new high, surpassing the September 2011 peak, compare the fundamentals today versus then. Then, 0% interest rates didn't exist. And I don't believe it was even imagined as a possibility. Today,
Negative rates, right?
right. So today, you have $15 trillion yielding less than zero. The Fed's balance sheet in 2011 was under $3 trillion. Today, it's about $7 trillion. In the meanwhile, U.S. nominal GDP is up 35% since 9 years ago. Then you get into the ECB's balance sheet has tripled in size since then, Japan, et cetera. The 5-year real yield, remember we talked about real yields in mid-2011, was negative 50 basis points, between negative 50 and negative 1%, versus negative 1.10% today. In the meanwhile, U.S. national debt, $26.5 trillion. It was $14.5 trillion in 2011. The dollar index is lower. Silver was about 50% below its 2011 and 1980 nominal highs this month, so it still has a long way to go back to those old nominal highs. So you're bullish on both of the precious metals, and you point out how much has changed from the last time we saw gold prices at these levels. And when I say changed, everything seems to be worse, and would augur for even higher gold prices in this rally. Is that the point that you're making?
Yeah, exactly. In our lifetimes, we had a bull market in the metals in the 70s. Then we had a 20-year bear market. The bull market, you can argue, in gold started in 2000 when gold was 250. We went up 12 years in a row to 1900 and 2011. We had a 50% correction. And then now we're I think, resuming that bull market.
It's a new bull market.
Yeah. I mean, there'll be a point in time when this bull market ends and you want to sell your gold and silver. I can't wait to sell my gold and silver because I'd rather
Right.
put it in other things. But there are times to own it and there are times not to own it. I think now is one of those times to own it. Now, I could have said that a couple of years ago when gold was much cheaper, but the theme really is the same. And for the factors that you mentioned that I wrote.
Well, negative real rates drive demand for gold because when there's actually a yield on treasuries, you can earn something for taking no risk. You can earn something for doing nothing, and it's like good enough for large pools of capital. But when you're actually losing money on risk-free assets, that drives demand to do something else, and that something else frequently is gold.
Right. So gold all of a sudden has a positive carry against $15 trillion of securities that have negative. And in fact, a negative yielding bond is no longer an asset. It's a liability because the owner has to pay to own that. And I look at gold as a currency, just as the yen, the euro. I mean, central banks own gold as a reserve. So that tells you that it is a form of money. Now, it's not money that you take to the pizza place and you exchange a coin to get a slice.
Right.
It's money from a monetary standpoint, and it does compare itself to fiat currency. Fiat currency, obviously, you can print ad infinitum. It's not easy getting gold out of the ground, and that's why over thousands of years, gold and silver were perceived as money because it was difficult to pull out of the ground and refined. It was sort of limited in its nature, and therefore could have been something that held value and could have been a medium of exchange.
All right, so let me ask you a question about that. I had heard that argument leading into the top for gold in 2011, and actually what ended up happening was the ultra low rates found their way into mining projects. Mining companies were able to borrow and frankly sell equity to finance massive production, which ended up putting a top into or helped put a top into the price of gold because of just the sheer massive quantities of supply. Very similar to what went on with fracking and oil in the middle part of the last decade, 2015, 2016. So I don't know that I really buy into the supply argument, but I understand the demand argument.
Well, it's silver. There's a lot more silver than there is gold. Gold supply only rises like 1 or 2% a year because even with a lot of the money spent on a lot of these projects, it's the grades of gold that are being found are much lower. So it's taking more and more discoveries to create the same level of supply. Now, I don't own gold because supply is very low, and I'm worried that they're running out of gold. Like, the peak oil arguments, both on supply and demand. To me, it's a monetary metal right now. Central banks have gone to all ends of the earth to try to inflate things, and they're doing that on purpose. It's not like it's a coincidence. They're doing this on purpose.
No,
They're trying to
they're
inflate
telling us they're
things.
doing this.
Yeah, they want you to inflate asset prices, and obviously now all asset prices are going up. It's not just gold; it's fixed income, it's areas of the stock market, it's antique cars, it's comic books, it's baseball cards. But that's what they want, and they want to buy this time until we get that vaccine, and then we'll see what happens when what they do when we do get the vaccine. But you can be sure that central banks will overstay their welcome with a lot of these easy. I mean, Charlie Evans, the Chicago Fed president, yesterday said that he wouldn't look to raise rates until inflation got above 2.5%. So even with a vaccine,
He should see my healthcare premiums. He should see my
yeah.
company's health insurance premiums if he's worried about 2.5%, because they're
Well,
going up about 15% a year.
Right. So to my inflation argument, and I've been talking about this for a couple of years, is that services inflation, X energy, so X like the gasoline station or whatever,
Yeah.
has been very sticky. Not high, but it's been 3%. And a lot of it's been rents, it's been insurance, with healthcare insurance up 20%. So medical care and rents have been driving. So you've had very sticky inflation of around 3% year over year. But you've had these goods deflation where goods prices are flat to down. For what we talked about earlier, naturally goods prices should go down as we become more efficient. We should always deflate. That's why parts of deflation are actually good. The computer you have in front of you is cheaper than it was 20 years ago, and that's good deflation. So the goods deflation has offset sticky services inflation. So if you run into a situation where because of all these supply disruptions around the world, demand comes back quicker than supply, you could get what I think a jump in goods prices, and you combine that with sticky services inflation. That's where you get CPI that all of a sudden quickly gets to 2.5 to 3.5 to maybe 4.
Wouldn't people argue though that that's what they would rather have happen?
Well, it's one of those be careful what you wish for, because the world's bond markets are not set up right now for a bout of higher inflation, considering where rates are. Okay. So while theoretically a central banker may say, yeah, this is great, we get to inflate our way out of all this debt, but that assumes bond markets accommodate that. I argue that the 10-year yield will probably not be 55 basis points if all of a sudden we have 2.5, 3.5 type CPI prints. The bond market will sort of revolt against central banks, and the central banks will have a choice. Do they fight that and speed up their QE, which then potentially could be further inflationary? Or do they then start to raise interest rates, which could get inflation back in control, but then can threaten economic growth?
How does the stock market react to not actually overnight, but like an overnight kind of reaction where 10-year treasury has to readjust and be 1% or higher? Like I would imagine the initial reaction from the stock market will ignore the reason, which is that the economy's improving. Right. And it'll get spooked. It has to, right? Because the stock market doesn't like surprises.
If the rise in the 10-year to 1% or more is because we're beginning to see some inflationary pressure show up in the statistics, it could be good for some stocks and not good for others. It could be good if all of a sudden commodity prices are part of that story. Well, then maybe energy stocks, which are a minuscule part of the S&P, maybe that starts to outperform. Maybe copper prices or industrials or companies that have pricing power will start to outperform those companies that do not.
I would imagine banks could be part of that.
If you start to see a steepening yield curve, banks can be a beneficiary. Those that will get hurt are PE multiples that are inflated. Like I was talking to somebody in my office today, taking Apple, for example. Apple's obviously great. They're delivering amazing numbers, but a big part of the stock price outperformance has been the PE multiple. Right. If Apple's PE multiple, assuming their earnings continue to go up, if their multiple just goes from 30 back to 20, well, that's a 33% decline in the stock with no change in the company, no change in the amount of iPhones they sell, and still a growth trajectory.
You won't get the offsetting growth in earnings.
Right, you'll get a decline in the PE multiple. So you take the secular bear market in stocks from 1964 to 1981. GDP growth was actually 3% plus. Earnings were still good, but you just had a valuation reset. So you can get a valuation reset in the expensive growthy areas in the market, and money can go to those companies and those businesses that have pricing power that will be able to pass on any cost pressures.
So
If you
that is
can't,
this elusive like growth versus value.
it,
Maybe
it, it, it is
that's what ends
potentially
it.
a catalyst for that. Yeah, because
Yeah.
I mean, when you think about value stocks, and I know people like to throw on a value stock as this homogeneous thing, but you have value traps. Like
Yeah.
I heard the story with Macy's at $30. Oh, it's value because the value of the real estate or whatever. But the business itself was a melting ice cube.
Yeah.
Then on the other hand, there could be value stocks where they're just temporarily out of favor. Their long-term business models aren't hindered, but they're just out of favor. Those are the stocks can rebound. The melting ice cubes, well, they may never rebound. So you have to really be careful with what you consider value.
It's so funny you're saying that. I was looking this morning. Lululemon and Ralph Lauren are both going to do the same amount of revenue next year. They're going to do between like $5 and $6 billion, or $4.5 and $5.5 billion, both of them. But Lulu's market cap is now $42 billion, and Ralph Lauren is trading one-time sales. It's like a $6 billion market cap. Well, why? Why would you have two apparel companies with that huge of a disparity? Well, because one figured out how to grow and one isn't. One is making money. Ralph Lauren just reported a massive loss this morning. So if all of a sudden people were to say, all right, I get it, Lululemon is doing great, but why am I buying the stock at 20 times sales or 15 times sales? I no longer need to, because there's a shift underway in the economy, and now rates are higher, and people start to reprice growth lower. That I think that could lead to a lot of upheaval in the market, even if ultimately it's healthy to see
Right.
that revert.
Because a lot, you look at every bull market in the history of the world, uh, yes, earnings growth is a big contribution to that, but PE multiple expansion is also a big contribution to bull markets, just as they are to bear markets where that PE multiple deflates. So
Right.
you could get a rethink of not necessarily the fundamentals of Lululemon, but you can get a rethink of what multiple you want to pay
Well,
for
that's what I
that same
mean.
set of earnings,
Right.
to exactly your point.
All right, last thing I want to get to. This is from my friend Ryan Dietrich, who does really great research at LPL. He was talking about gold versus the S&P 500. I want to hear what your thoughts are on this, because I think that a lot of the people that are watching this video might be under the assumption that if gold starts to really work, it'll be because something's wrong in the stock market. But Ryan says so far, 2020 is the first year since 1979 when both gold and the S&P 500 have made new highs during the same calendar year. I didn't know that. What happened last time? In 1980, gold added another 17%. The S&P was up 26%. So he's making the point, like, it's widely believed that gold prices are indicative of everyone getting defensive and something being wrong. But it's not always that simple. And there are periods of time where the two trend higher together. What do you tell people that ask you, well, if you're bullish on gold, how could you also want to own stocks?
I agree, and even mid 2000s, stocks traded well. Gold went up. Gold is a form of money. Do not look at gold as, oh, the world is falling apart, I need to own gold, or the world is a scary place, I need to own gold. Gold is just another form of currency, and if fiat currencies are being disrespected by central banks, well, gold looks more attractive. If interest rates are low relative to inflation, gold looks attractive. Gold should not be looked at as a safety thing, unless you're going to another world war and you only can exchange things for gold, but that's not happening.
Is there an element to the gold
It's
rally, though, that has to do with the coming election, or do you think that's not really what's going on?
No, I don't think so. I think geopolitics will influence the price of gold one day here, one day there. When Iran bombed Saudi Arabian oil fields, oh, the world's scary, I need to own gold. That rally lasts a day or two.
Yeah.
Just look at gold as just another currency relative to other fiat currencies. There are going to be times to own gold. There are going to be times not to own gold. Now just happens to be one of those times to own gold. There obviously people have different ways of valuing gold. Now, gold doesn't produce any cash flow, so you can't base it on that. But people value gold relative to central bank balance sheets. They value gold relative to trends in inflation. There are different ways of valuing it.
I only
If
look at
you,
it. I only look at it technically.
or
I
you
don't
can
pay
look at
any
it
attention to
technically.
that.
So
Yeah.
I think 3,000 is a fair price. Gold can go to 5. There are people out there, they say 5 to 10. I'll probably be out at 3 and let everybody else ride it from there.
All right, you heard it here first, guys. Peter Boockvar, gold to 3,000. There's a lot of ways to look at it. There's a lot of ways to value it. I appreciate your point of view. Guys, go to bookreport.com, BOOCK report.com. Check out Peter's stuff. Let us know what you think in the comments below. Go ahead and like the video if you liked what we had to say today. Subscribe to the channel if you haven't already. We will be back with you very soon.